let's talk about GameStop. What the heck happened this past 2 weeks? How does a stock go from $4 a year ago to touching $500 this morning? So let's set the stage, right? Let's go back in time. 6 years ago, I'm looking at the total revenue. This is the total revenue numbers for GameStop. Back in fiscal year 2014, they were making $9 billion a year, and they've been steadily downtrending since then. So they made $6 billion last year, almost 50% what they made 6 years ago. So with that being said, the death of GameStop is the result of gamers are actually downloading their games online now, pretty much. So they're not going into retail stores to buy their games. So you got that, plus the coronavirus pandemic, where that was the death of retail in general. So you have this double whammy scenario where Wall Street is betting against this stock, because how can a situation where people are buying them online already without the pandemic, and then you have the pandemic who is discouraging, which is discouraging people to go to retail stores. This is setting up a situation where, hey, I want to bet against this stock. Well, the way you make money in a standard way in the stock market is, of course, we all know this, right? Buy low, sell high. I buy a stock at $5 and I sell it at $20. I make 4 times my money. That's the normal way. We call this going long in the stock market. When you say I'm going long, that means I'm expecting it to go from low to high. But there are exactly two ways to make money in the stock market. There's another way. You can actually sell high and buy low, which is crazy. How can you sell something you don't own? We call this shorting. And I'm going to go through an example that's really popular on Twitter and on Reddit of how the heck can you sell something you don't own, buy it later, and make money? It doesn't make sense. It doesn't intuitively make sense. So let's make it make sense. So there's a gorilla, and he's got 5 bananas that are worth $10. He's got a friend who's a snake. So the snake sees the bananas that are worth $10, and he says, dude, those are clearly overpriced bananas. I'm jumping the gun. I want to bet that buying 5 bananas is going to go from $10 to $2. There's no way that, like, bananas are overpriced at $10. And so the snake, he goes to the gorilla and he says, hey, let me borrow your 5 bananas. I'm going to pay you interest for borrowing your bananas, and I'm going to give them back to you in a few weeks. So the gorilla's like, okay, cool. Like, I'm still going to get my bananas back. So he hands the bananas over to the snake, and the snake now has 5 bananas that he can do whatever he wants with. So now this is what's called borrowing, of course. So now this snake can sell all of the bananas at $10. So this is what the snake is trying to do. How shorts make money in the markets. The snake borrows those 5 bananas at $10, and then he tries to buy them back at $2. So that means he made an $8 profit, because he sold them at $10. The gorilla has 5 bananas. The snake goes to the gorilla, grabs the bananas, takes the bananas, sells them at the market for $10, and then waits, right? So that's what he's paying interest to the gorilla for, because now the gorilla doesn't have his bananas. So time goes on, the price of the bananas dropped to $2. The snake goes to the market, buys them for $2. So the snake already has $10, spent $2 of that to go buy the bananas, gives the bananas back to the gorilla, and guess what? The snake made 5 times his money. Well, that's how shorting works. You borrow it, and then when you end a short position, you have to what's called cover your position. You have to cover your short. So if this is what shorting is, what happens in a short squeeze? So say on the day that the snake goes to the gorilla to borrow those bananas, there was a viral YouTube video where a famous chef came up with this amazing banana pudding recipe, and the video went viral. And all the gorillas are like, holy crap, I want to make this banana pudding recipe. So the snake, on that same day, he sold the bananas at $10, but the market went into a frenzy. Everybody wants to make this banana pudding recipe. So the gorillas are just buying bananas. We're going to make this banana pudding recipe. So everybody's buying and buying and buying bananas. And guess what? By the laws of supply, I see you, Wesley. By the laws of supply and demand, the banana price must go up. So if the snake initially sold the bananas at $10 and the price of the bananas triples, right? Because of the banana pudding craze of 2020, and the price of the bananas go to 30, the snake is forced to buy the bananas at $30. So he borrowed the 5 bananas from the gorilla, sold them immediately for $10, is waiting for it to go to $2, but it spikes up to 30. And then over time, well, the snake's like, well, I guess this is the new price of the banana. So I've got to buy it. I've got to buy them at $30. So only made $10, bought them at $30. So that means the snake, to settle his debt with the gorilla for borrowing the bananas, the snake is losing $20. So as you can see from this example, had the snake gone long instead and lost all of his value, right? So say he bought it for $10 and the value of the banana went to $0. He'd have only lost 100% of his account, because when you go long, you can only lose 100%. The danger of a short squeeze is that shorts can suffer infinite losses because a security can go over 100% in price. So here's what happened on GameStop. And this is not a fanatical example. The price of GameStop went up 30 times over the course of the past month. It started at $30 It started at $30 at the beginning of this month, and it spiked up to $500 today. So it's actually more than 30%. So say in this example, the snake borrowed the bananas at $10, and he goes to the market to cover his short, and the bananas are $300 for 5 bananas. So the snake is underwater 2,800% of his trading account. And this is what happened on GameStop. So the most important aspect of this to understand is that short sellers can suffer infinite losses because securities can go up over and over and over percentage-wise. So when GameStop goes up almost over 3,000%, anybody who's short, they owe 3,000% of that money. So if you bought in for $100, you now owe, what's that, $30,000? No, $3,000. Is that right? Yeah, that's right. So if you shorted $100 worth of GameStop stock, you now owe $3,000. This is an impossible situation. This is why we saw what we saw today, where we saw Robinhood, we saw TD Ameritrade, where they were limiting trading. We're talking about billionaires who are underwater for billions. We saw hedge funds getting bailed out yesterday by other hedge funds. So how much does it cost to pay millions of dollars to Robinhood to limit trading? Like, the powers that be, they showed their hand. They showed their true power because of how much loss that you can suffer in a situation like this, 3,000% losses. So to protect the situation, so here's what brokers do. Because guess what? If I only have $100 in my trading account and I owe you $3,000, how am I going to get my money back, right? If you owe me $3,000 but you owe me $100, how the heck am I going to get my money? So what brokerages do is they have a for short sellers, because they can suffer infinite losses, they have what's called a margin call, where when you go short on an exchange, you agree that you only can take a certain amount of loss, and you're forced to buy your book. Because when a short, remember, like initially the snake sold those $10 worth of bananas to exit his position. To get those bananas back to the gorilla, he has to buy. And what does buying do? Buying decreases the supply and increases prices. So the reason why the GameStop short was so magnificent and such a historic phenomenon is because these shorts were already underwater 3,000%, and they're holding on. They're holding the line. They're trying to not buy back the stock, because if they do buy back the stock, then guess what? They're in for millions of dollars. The price goes up. This is why people on Reddit were predicting GameStop going to $1,000. And this is still possible. The short float is still over 100%. So the short float means that almost all the GameStop shares are shorted because of the situation of everybody buying online games. So this is the powder keg scenario that we're in on GameStop. So let me remind you, remember, GameStop, it's losing value. You've got online gaming. You've got the pandemic that is setting the stage for a situation where clearly GameStop's going to go broke. Well, and so you've got this high short interest where the number one stock on the stock market right now that's being shorted is GameStop. Like, there are more shares short than actually exist on GameStop. And so that's why it's been behaving like a penny stock, because when you short, remember, like to short, I had to borrow those shares from the gorilla. So that means those shares they're not available for trading because I borrowed them. They don't exist. Like, to give them back to the gorilla, those shares aren't available for trading. So this is what I've been learning from as I've been reading about this. What I've learned is that brokerages, they offer shares for short, even if they don't have them yet. So the reason why you can have more short shares, shares shorted than exist, is because brokerages are pretty much saying like, oh, well, like, I don't have to make due on this because most of the people who short are going to make due on their bet and they're going to buy it back. So I don't actually have to own the shares. With that being said, going back a year ago, this user on Reddit, Deep Effing Value, is a legend in the Wall Street Bets community. Here's why. He saw this a year and a half ago. He took a large position. He spent $50,000. If you see on this at the bottom of the screen, he took a $50,000 position, and as of yesterday, he was up 22 million on GameStop. That $50,000 short that he saw a year and a half ago. So this is the situation that we're seeing. We've got Wall Street, who's betting more shares than exist on betting GameStop to go down. Someone a year ago saw the situation setting up on Reddit, and he said, I'm gonna bet. This doesn't make any sense. Like, how can you short more shares than exist? And then he actually has a YouTube channel. His YouTube channel is called Roaring Kitty. They got this deep effing value. He's an overnight internet celebrity. If you were to go to the Wall Street's Reddit page, like, literally his post is number 2 on the page because he's updating people in real time. He's been updating every single month since a year and a half ago. So you have this situation where you've got this powder keg set where you got Wall Street Bets, and this guy is on Reddit, and you can see that there's only 46 likes on this in the top left corner. This wasn't that amazing. Like, it was just incredible. Like, why the heck are you going long in GameStop when everybody's shorting it? Well, this is the tweet that set it all off. January 19th, 2021, Citron Research, a guy by the name of Andrew Left, he recorded a YouTube video. I couldn't find the YouTube video because they might have I think they took it down. They literally were talking trash to people who were going long in GameStop. So if we read this tweet, Citron will live stream the 5 reasons GameStop buyers at these levels, and these levels being $30, are the suckers at this poker game. Stock back to $20 fast. We understand short interest better than you, and we'll explain. This is what set the internet off. So on Wall Street Bets, you have this guy, Deep Value, who saw this a year and a half ago, and you got this guy on Twitter who set the stage for talking crap to anybody who's going long. And then you've got this group of traders who've been theorizing about GameStop being overshorted. And so now he's poking the flames of this fire. And so they all started posting in the Discord channel for Wall Street Bets, and on the Wall Street Bets Reddit channel itself, they said, buy GameStop, F this guy, F the hedge funds, let's screw this guy over. And that's what started this whole thing about 2 weeks ago. And so then we saw GameStop go from $4 a year ago up to $500 today. This is the story of how a short squeeze happens, and this is the story of GameStop. Comments, confessions, thoughts?
Yeah, I got a quick question. For this to happen, though, like Reddit, I mean, I'm not saying there was no inside information or whatever, but like what you said, that guy sent out that tweet or whatever. Wasn't this like a combination? I mean, this don't happen a lot, or maybe it does. I'm not sure. but something like this, didn't certain things had to line up just right for this to happen?
Right.
I mean, because the way the hedge fund people, it was like they were big and bad and all this, and then the normal people like David came and slayed them and made all this
Right.
money. You know, so I'm just saying, so to see this, like you're a lot better than all of us. Is this something that you kind of seen too coming, or as it was unfolding, you said, hey, this is something here?
So I did not see this in advance. I was not aware of this, but I saw this situation and I understood when I saw GameStop at $60 and I looked at the short float and I saw that it was over 100%. I knew immediately that it didn't make sense. Okay. You can't have every share in existence going down. Right. That means that there's no shares to trade. And if there's no shares to trade, then that means any buying pressure is just going to drive it up. And it's a self-fulfilling prophecy. So because there's only 100, so if we look at the short float, like if we go to finviz.com, or not the short float, we can look at how much. So when we say the float of a stock, so the shares outstanding, right? Can y'all read this? This is really small.
Yeah.
Okay.
I can see it.
There are only 65 million shares of GameStop. So this is a very small amount of shares for a stock. So the number of float shares, so there's 65 million shares, and then the float means there's 50 million shares that are available for trading. So the float means even though there's 65 million shares in existence, there's 51 million available on exchanges. So we have a short float of 100%. So it's already a low float. This is an incredibly low amount of shares. So we have a low amount of shares. Every share is short. Low amount of shares. Every share is short, and so that means that there's this small subset of shares that are actually being traded. So like, let's even call it like a million shares, right? It's actually probably even less. If there's only a million shares, then like any price fluctuation, like it only takes $1 million the stock price was like $30 at the time. So if it's $30, if there's only a million shares that can be traded and they're worth $30 each, that means it only takes $30 million to double the stock price. So if it's worth $30 million, because everything's locked up, right? When you're shorting a stock, you lock up the stock. So if the stock is locked up and there's only $1 million, it only takes $30 million, and you have all these people online who are buying this stock. So to double the price from 30 to 60, it only takes $30 million. And so now you've got $60 a share and 1 million shares. Now it only takes $60 million to go from $60 to $120. Like this was a very special scenario where you got, go ahead, DeFazio, my bad.
So you on one of these things I want to point out. So there's another two factors that helped this like explode like it did. Like, cause like Josh has been explaining that this has been amazing. Never seen anything like that. This is a very historical moment in time with this in the stock market. But one, when you are going short, you like Josh said, you have to borrow shares from the broker, and somebody at that brokerage firm has to own those shares, or that brokerage is like, I'm gonna cover them, I'll get them somewhere later. So in order to do that, they have to have permission from the people who own those shares.
Right.
Be able to short those shares. So when you sign up for your brokerage firm or your brokerage account and you sign up for options, you probably in all that writing, the things terms and agreements, you probably checked off like, yes, I will allow my shares to be shorted if somebody's asked to. So what those people in Wall Street Bets did, they conspired with their cohorts and like, call your brokerage firm, tell them you do not want to lend your shares out to be shorted, because what somebody can do who's in a bad short position, they can just short more above where the price is, and hopefully that it continues. It can go down from there and they'll make some money there. So that's one thing the shares short, they couldn't do that part. And number two, when there's a margin call, like you are forced to get out the position or forced to put some money into the position so you can cover your costs, cover your short. And so like Josh explained, like, so they want to hold tight. They don't want to buy, because once you buy, that's triggering buying pressure. And as more and more people get margin calls and you got more buyers than you got sellers, there's nothing it can do but go up and continue to rise. And it's going to rise exponentially at times because those positions are so large. Like 100+% of shares short is astronomical. Like I don't know how they can even let that happen. Like, I mean, I guess they make a backdoor handshake deal and let that go down. But those things are self-manifesting. They build on each other and they just cause for that parabolic return that we've seen. And I wish I was on Wall Street Beats and I could have participated, but I am not.
Yeah.
I wanted to add that in there to help further explain how it's been so impactful these past couple of weeks in the stock.
Go ahead, Mr. Harris.
One more comment on what Mr. Fields was saying. When I was looking at my Webull account, they were saying this, about how you was talking about they can take your stocks and do something with them. They saying I need to turn off my stock lending income program. Is that sort of what you're talking about? Is that what then that won't give them permission to short or whatever do with your stocks? Okay, so that's what people were saying. Hey, yeah. Now, but back to what you said about the 65 million shares of stock. Okay, if they only got that amount of stocks and people were buying them, for me to buy somebody's stock, somebody got to sell some stock, right?
That's right.
But then who was in their right mind selling the stock? Was it them hedge fund people?
So who's selling the stock? So that's probably people. People all around were saying. I got a text immediately when GameStop popped to $30 from $19. I literally got a tweet. Someone hit me in my Twitter DMs and was like, "Yo, like, did you see GameStop today? Like, I just sold at $30. It was amazing." And I was like, "Oh man, that's awesome!" Like, I didn't see that move. Okay. Yeah. So, because it's all relative. Because at the time it had spiked 50%. Yeah.
Right. So people are going to take advantage of their gains and think, oh, they never imagined it was going to 300. So I done made double money. I'm selling mine. And then somebody came behind me and bought those. Okay. I see. So there's always going to be a trade and a sell-off. Okay.
Right.
And also, if there's not a person on the other end of that transaction, the brokerage firm will take that action.
Okay.
They're like, big hedge firm X, they see the inequities in GameStop and they want to exploit them. So I'm a short it. There's nobody that wants to sell them. So brokers were like, I got you. I'll take this action. And so they take the other side of that transaction. Hopefully that they can make the money on the end. But if they get caught up in a whirlwind and don't have the coverage, I mean, stuff can get really bad. And like some of these hedge firms are going out of business because of this.
So that's what Webull or Robinhood does for us. They when I say, okay, I want to buy some stock, they reach out and try to find the stock no matter what for that I'm trying to sell, buy with it.
They're like a market maker.
Right.
A whole bunch of people interested in buying and selling stock, and they just got all these orders from both sides, and they're just taking them and matching them up.
Okay.
And they can't match them. Like sometimes they'll take the action. They'll take the bet. Like, and that's in essence what they're doing when they're shorting it, because they're not actually physically removing the shares from somebody's account, saying, "Oh, somebody sold your shares short." They just have that. It's like an accounting thing. Like, so you are in that bed with the brokerage firm, not another person.
Okay.
Yeah, so that takes us to the next step of this, which is how the heck do we avoid getting